The rise in shelter costs picked up in June and was a major contributor to inflation, along with food prices. Most of the 4.8% rise in shelter costs was due to higher mortgage interest costs and, to a lesser extent, higher rents. But counting only the rise in mortgage interest and ignoring the fall in principal payments while calculating the consumer price index distorts the data, according to our next guest. Joining us now is Benjamin Tal, Deputy Chief Economist at CIBC Capital Markets. Benjamin, thanks so much for making time for us today.
Thank you. It's a pleasure.
So let's first just touch on the headline rate here for inflation coming in below 3%. But how do you sort of see this playing out from here?
Yes, let's not get used to it, because it will be over 3% over the next 6 months, because we have a base effect, namely gasoline prices were in the sky a year ago. So on a year-over-year, you see a base effect that leads to a significant decline in inflation. Then it will stabilize. So let's say 3.5 will be a reasonable number for all items CPI. So don't get used to it. It's really not going to continue.
Okay. So brace for higher inflation in the months ahead. What about these shelter costs and zeroing in on this mortgage interest cost, jumping 30% year over year? How should we be thinking about that when we're thinking about the overall inflation gauge? Because we know that those interest costs are really coming from higher interest rates, which are intended to bring inflation down.
Exactly, and that's the story. We have to really distinguish between Canada and the U.S. when it comes to shelter inflation, because in the U.S. it's all about the rent. And that's why, with rent rising, we have seen shelter inflation rising, and now it's starting to slow down. Canada, it's a much different story, very different story, and there are many factors there. But the most important one, as you mentioned, is interest cost on mortgages. And it's rising by 30% on a year-over-year, the most significant shelter item. Now, think about it for a second. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are adding to higher mortgage costs. That is adding to inflation. You see, it doesn't make any sense here. So by raising interest rates, you're actually contributing to inflation. And you know what? Nobody will be able to convince me that higher mortgage interest payments are, inflationary. They are disinflationary. When you and I have to pay more on our mortgages, we pay less on something else. We spend less. Therefore, it's disinflationary. So it's very problematic. Now, if you look at the debt service ratio, namely how much we pay to service our debt, which is interest and principal, it's basically back to 2019 level, despite the fact that the interest rates went up by 450 basis points. Why? Because interest payments are rising, but as we all know, principal payments are going down because amortizations are rising. But we are adding interest payments into the CPI, but not principal payments. Tell me, is it fair? So it's very problematic. And I think that usually when interest payments are rising by 3, 4, 5%, no big deal. But when it's rising by 30% on a year-over-year, being the most significant contributor to inflation, I say, let's stop for a second and think if it makes sense. Do you want to raise interest rates again and again because of the fact that you pay more on your mortgages? It simply does not make sense.
It's a question that the Bank of Canada Governor Tiff Macklem was asked actually a couple of times at the press conference last week, including, though, by our Amber Canwar. And let's just take a listen to what he said in terms of, viewing or how to view these, higher mortgage interest costs.
When you raise interest rates, cost of mortgages, cost of borrowing costs go up. And so that does boost that component of the CPI. And of course, if you take things out of the CPI that are going up, what's left is going up more slowly. So yes, if you take mortgage interest out of the CPI, instead of 3.4, you're left with 2.5. On the other hand, if you take things out that are falling, what you're left with is going up. For many Canadians, gasoline is a major expense. If you take gasoline out, what's left is going up at 4.4%.
So, Benny, he's, talking about being selective, and he doesn't want to be selective about what they're taking into consideration there. But what did you make of it?
But the gasoline prices are rising not because of higher interest rates. Mortgage interest payments are rising because of higher interest rates.
Yeah.
You see? He's causing it. So there is a direct impact of the Bank of Canada's policy on inflation. So we have to think about it, and we have to basically, at the minimum, add principle to it. And clearly, they're not doing that. So it's really not a very accurate way of looking at the situation. And if you take interest payments out of the story, all of a sudden, all item CPI is 2%, and actually core CPI is 1.5% below target. So we have to think about it. I'm saying something is problematic when you have 30% increase in interest payments because of the policy of the Bank of Canada, and we're adding it to inflation. It simply does not make sense.
I hadn't thought about the principal payment part to it, Benny, because, yeah, if people are extending the length of time that they're paying their mortgage for, extending their amortization, then yes, the principal amount would be lower so that they can make up for or be able to handle those higher interest costs. That's an interesting component to it. When you're thinking about the Bank of Canada's expectation for how long it's going to take them to get inflation to that 2% target, pushing out the timeline to 2025. What are you thinking? Do you think that that's a timeline that we're going to follow, or will the Bank of Canada get there faster? Although you're talking about stripping things out already, and we're there. But, if you're looking at what the Bank of Canada is looking at, do you think it's going to take all that time?
First of all, I have to give them credit. The decision to raise the forecast for the second, third quarter of GDP and to extend the timetable for reaching a 2% inflation to 2025 is brilliant. Now, this is their forecast, but it's not a forecast. It's a positioning situation. They are positioning themselves to some sort of changes in scenarios. Basically, they are buying time. You see, if you say, listen, inflation will take longer to get to 2%, but it will get to 2%, then you basically put a cap on inflation expectations without too much cost. If you raise your GDP growth forecast, if you have surprise on the upside for GDP or any other economic indicators, they can tell you, listen, we don't have to overshoot because it's already in the forecast. So they are basically trying to limit the degree to which they are overshooting because they are already overshooting, and I think that they know that, and also buy time to get inflation to 2%. And the more interesting question is, let's assume inflation goes to 2.8, 2.7, 2.6, and then 2.5, and stabilizes at 2.5. So what to do now? Are you going to kill the economy just to get to 2%? Or are you going to say 2.5 is close enough?
I'm glad I'm not the one deciding, Benny. Yeah.
Yeah, I'm asking myself this question. Is it close enough? Let's remind ourselves that over the past 20 years until COVID, inflation was 2% target, but the actual inflation was like 1.8. So we were undershooting for 15 years. Maybe we can overshoot for another 20 years. So that's an interesting story.